Okay, so in my last video on HSA basics, I covered that the contributions to a health savings account go in pre-tax, and then it grows tax deferred. And if withdrawn correctly, the money comes out tax-free. So now let's cover the specific withdrawal rules so that the monies do actually come out tax-free. What are the withdrawal rules for HSAs, and are there special considerations, things that we need to know? Again, I'm going to cover this fairly quickly, but I will put a sort of one-page giveaway or basics on the website, okay? So, first point, withdrawals can be taken at any time on a health savings account. There's no holding period like there would be with a Roth IRA, for example. The entire withdrawal, including the earnings, is tax-free. So as long as there is a corresponding qualified medical expense. Now, the medical expense must be incurred by either the owner or their spouse or dependents. Additionally, the medical expense does not need to occur in the same taxable year as the withdrawal. Instead, the medical expense must simply occur before the withdrawal is made. Number 2, HSAs are owned by the individual. That means that the balance carries over year to year and stays within the individual's account, even if he or she changes jobs or health coverage. If someone is no longer covered by a qualified high-deductible health plan, he or she can still take distributions from the HSA. This includes individuals covered by Medicare. Number 3, unlike flexible spending accounts or health reimbursement accounts, an individual does not need to substantiate a medical expense before withdrawal, which means that that person does not need to have or provide receipts or other proof that a qualified medical expense has occurred before accessing the account. But I would definitely retain documentation in the event that you unlikely receive an IRS audit. Okay, number 4, HSAs are not subject to the required minimum distribution rules that you see in an IRA or 401k. And there is no requirement that the monies be used on current medical expenses. So this means that HSA funds can remain in the account over the life of the owner and be used to supplement Medicare coverage during retirement years. And then last, if an HSA account is passed to a spouse, the spouse beneficiary can continue to take withdrawals on the same tax-free basis. If a non-spouse beneficiary is named, because you have a beneficiary listed on these, the HSA ends on the date of death, okay? Now, what are the penalties? What is the rule that we're worried about? So if we don't follow the rules, the penalty is pretty stiff. Not only does the entire distribution get added to your income, right? So you add whatever that distribution is to your annual income that year, but it is also subject to a 20% penalty. Now, the penalty would be waived if the HSA owner is 65 or older or disabled at the time of distribution. However, so that means the penalty would be waived, but the distribution is still treated as taxable income. Distributions are reported to the account owner and the IRS on an HSA using IRS Form 1099-SA. So I covered a lot really quick, but I will make this available, this one-page handout available on my website covering HSA distribution rules. But please understand that this, just like all other aspects or nuances in financial guidance and planning, is very important. So again, this video is not intended as investment or legal or tax advice, but as information, and I hope you found it helpful.